Welcome to another episode of your favorite podcast, Real Estate Unleashed. I am your co-host, Bridget Quinn. You can find me on all social media, B Quinn Realtor.
And I'm Regan Hildebrand with the Home Team Realty Group. You can find me on social media at Realtor Regan. Welcome, Bridget.
Welcome, Regan.
All right, so we're here and going to dive into it. I'm trying to get my microphone. Just move it all around there.
Put your left hand in.
Yeah. Put the microphone out.
All about.
Fidgety kind of day. Little loan topics today. Gosh, I'd keep bumping it now. Off to a great Monday start.
It's one of those Mondays where all I want to do is scratch my eyeballs.
Yeah. Allergies are in full bloom. Pollen's in full bloom, I guess, causing the allergies to be a headache on us. But speaking of headaches, we want to give people a little tips on how to avoid headaches of understanding the different types of loans.
What they mean.
What they do.
What's best for you.
How to not have your head explode.
You may still have your head explode anyway, regardless. But
this is not one of those topics that gets everybody all excited all the time. But hey,
it may grind your gears.
It might grind your gears, but you have to talk about it at some point.
Yes, you do.
We kick the can, but at some point, you have to kind of figure out what loan type is the right thing for you. If you're a buyer out there in the market, or if you're a seller, which type of loans are going to affect maybe your offers that you're looking at, those sort of pieces to the puzzle.
Yep.
Yeah. If it's cash is still king.
Cash is always king.
But
We've
sometimes,
said that before.
Yeah. Sometimes though, you got to deal with financing.
Yep.
And
there's nothing wrong with that. I mean,
not at all. I mean, I think in our market at least, probably 95% of homes close with some kind of financing, unless you're dealing just with investors.
Yeah. I would say so. Especially now, kind of coming back into the normality of everything versus, in the heyday of tis the season.
Mm-hmm.
Last year, we were dealing with a bunch of cash offers or programs that offered cash, whereas now I think it's back to normal where most every offer is some sort of financed situation.
Yeah, I think so. You mentioned the programs that work like cash. We had a lot of things that could take people's financed situation, remove the financing contingency, and present it like cash.
Mm-hmm.
Now, with the market doing what it does, a lot of those options have either dried up or just don't make sense to have to pay the fees that are associated with them.
Right. That was the thing. There's always a cost associated with doing that sort of business, and a lot of times that was the fees behind the scenes to the buyer of extra percentage or, just straight out-of-pocket costs to deal with it.
Yeah. And the out-of-pocket cost is always a piece of the equation when you're dealing with how do you want to buy your house. And the big thing that most people will have to figure out is what is going to be their cost situation, what's coming out of pocket,
yep.
What are you having to deal with in your loan payments on a monthly basis, how long are your payments going to last?
Yeah.
Are you going to do a 15-year loan?
I would say,
30?
that has a lot to do with typically which loans you go with, if you have a lot that you can put down as a down payment, can sort of lead to choosing one over the other too.
Yep.
Or your asset side.
Yeah, and we'll break it down into just the main categories. You got your conventional loans that we can talk about first. That's the ones that they're called conventional because that's just the old school type of loans. That's what most people dealt with. Historically, we didn't always have the government-backed loans that we'll talk about a little bit later. You just dealt with conventional type loans.
Right.
Which you might have put 20% down in an old-fashioned kind of way. That was the
But
expectation.
again, way back when, the
when.
prices, roll back.
Mm-hmm.
Those prices on the house weren't what they are today. Do you know what I mean? Mom and pop may have put down a house of maybe $80,000 total. Do you know?
Yeah, and 20% of $80,000 is not going to feel as much as 20% of $700,000 or $800,000.
I sure don't have that kind of money laying around.
No, and I think the only time that you really see people dealing with a realistic scenario to put 20% down is if they're taking equity out of the sale of their other home, their current home.
Right.
So if you're a move up or maybe you're a downsizer, then you might have some equity that you can transfer from the previous property to the new one and get that 20% down. But you and I being agents, we see the I guess a large enough swath of buyers and sellers alike to know that most people don't ever put 20% down.
No, I would say most people that I've dealt with have put an average of like 5 to 7%. You know, some of, as you say, some have put down more, obviously, because they had a house to sell or something else to kind of do that. But mostly people generally tend to put the bare minimum down on the loan, or the bare minimum plus a little bit.
Yep, and a lot of that was influenced by the past interest rates that we've seen, where it didn't make sense to take all your money and throw it at a 2.75% mortgage when you're not going to really get bang for your buck again out of that. So why put 20% down when you're only having an interest rate of 2.75? You're not going to see a huge savings. Now with rates higher, there are some situations where it does make sense to put more down.
And a good lender will tell you kind of what those break-even points are.
Yep.
And tell you, hey, I know you can afford to put 10% down, but let's do, say, 5% or 6% or some sort of combination of things.
It's all about the math and figuring out, and a good lender, will absolutely work the numbers for you. But just for the sake of understanding things, a conventional loan typically has that freedom to get you from 20% plus down as little as, well, kind of asterisk beside this, but as little as nothing down in some cases. There are some very creative conventional loans out there with 100% financing, and we talk about LTV, or loan to value. And your loan to value is, again, just exactly that. It's a ratio of how much your loan is to the value or the purchase price of the property. So you can have 100% loan to value or 100% financing, no money down, different ways to say the same thing, and not have anything for your down payment.
Right.
Which is, as we said in previous episodes here, is a big difference between nothing out of pocket. Like you said, you have to.
You still have skin in the game of some sort, right?
Yeah, cost associated.
I think it's important to understand LTV, because loan to value, because that sort of dictates, at least when I'm writing offers, let's say that somebody is putting that 20% down, or maybe they're just going with a conventional, but they're putting that 10% down. We can add that into the offer, and it makes it look a little stronger to the seller, and it's less risky, if you know what I mean.
Yeah, exactly. It's more to that skin in the game point that you're talking about. If you do have a larger down payment, sometimes a seller, if all other things are equal, may give more weight to the person who's got the ability to put more down, therefore less risky to the seller. But yeah, there have been situations before where it maybe not makes sense for the buyer to put a bunch down. So it's a good thing for the agent then, if you're a buyer's agent presenting an offer, to be able to explain to the listing agent, and then them to explain it to the sellers, why is this loan structured the way it is, and to not just put it on the table with no explanation.
I would say most conventional loans, though, typically you're not doing the 100% financing creative ones, just a straight out of pocket, typically are around 5% minimum to put down.
Yeah, I think that's probably the average that you're going to see with most things, is a 5%.
And as I say, along the way, I know that a couple had like a special offer. If you were like super qualified or like excellent credit, then they would allow you to only put down 3%, but it was a kind of like a special incentive. But typically 5%, I think, is a rule that we see.
Yeah, I think that's the most common. You'll see the 3%, you'll see 3.5%, and 5%. You'll see those weird ones that say 100%. A lot of times they come with catches. It might be an adjustable rate mortgage, ARM, we call it. Which you got to ask your loan officer what's entangled in all that, because if it's not a fixed rate, then that means that at some point...
fixed rate means it's fixed.
It's fixed for the life of the loan. It cannot change.
Unless you refinance it.
Unless you want to do it on your end. But the lender will show you a closing disclosure that states this rate cannot change over the life of the loan. Whereas an adjustable rate is going to have a period of years, usually, that you're that you have a rate, and then it adjusts up, always up, and it might have minimum a half point percentage all the way up to 2-3 percentage points. You got to ask the questions. You got to be informed as the buyer.
So some of those may be better if, in the short term, which we had talked about 2-1 buy down before, sort of the same thing, but kind of different. You got that a little bit cheaper in the beginning, but it keeps going up and up and up. And does that work for you with you not 100% knowing what that rate is going to be?
Correct. Yeah. So there's all these little creative pieces that you can attach onto the loan itself to get you where you might need to be. Back to your point before about having a good loan officer at least in the passenger seat with you, navigating that process, your navigator, because otherwise you could be off.
Or go off the cliff.
Off the cliff.
Off the cliff. Yeah.
The conventional loans though are what's going to suit most people because
they're straightforward, easy peasy.
Exactly.
There's a appraisal that goes along with them.
Yep. There will be some kind of determination of value, right? I just had a great one though that was a conventional loan that my buyers are moving forward with, and they're taking the equity out of the sale of their other house to put forward on this one. So they're a lot more than 20% down because they have so much equity that they're moving from old house to new house, that they're so far over that threshold, they got an appraisal waiver.
Oh, nice.
Which is nice about a conventional loan. You have more flexibility.
You do.
There's not a government entity attached to it that's calling some shots along the way. And
sometimes I've seen that too, where they don't really need an appraisal, but they still may do a desktop appraisal just for the sake of having it.
Just to check the numbers,
just to check the numbers, right? But you're right. It doesn't happen much, but there's times when it can. You put so much down that you've alleviated that risk.
There's no risk to the lender, so they don't have to do that.
Yep.
Might save a little out of pocket.
Oh, my nose is so itchy.
And I'm coughing, and we're just,
We're not
allergies.
sick. It's allergies.
Gosh. But I think that sums up like the conventional bucket. There's all of these little things that you could run off in tangents on. But when we come back for part 2, we're going to jump into the one that seems to be a good fit for a lot of first-time buyers, FHA loans.
Yep.
And we'll tackle those. So tune in for the next episode as well.
Absolutely.
But if you want to get notified when that next episode drops, you have to hit the subscribe button and the little bell beside there to get notified for all new episodes. Subscribe.
Who doesn't want to see our faces all the time?
Every Friday, we're here with you. We're explaining something or hacking and sneezing during it. Follow us on social media. We're on Instagram at Real Estate Unleashed, and we're on all other social media, the TikToks,
the TikToks,
the Facebooks. Whoever, wherever, whenever, we're there. So interact with us.
You sound like Shakira.
On that note, leave a comment, drop a line, reach out to us. Contact info is below if you have questions or comments or things you'd like to hear us talk more about. And you can find me on social media at Realtor Regan.
And you can find me on social media, B. Quinn Realtor. And as always, we'll catch you next time.
Thanks, guys.